Rakesh Arora from Macquarie Capital joins us on the show. Firstly, Rakesh, hi, morning. Your first take on the shocker by the RBI.
You see, RBI has done a little bit of tweaking as to what they had announced earlier, because what they announced earlier wasn't really, making an impact. So, it was kind of already built into the price, and you can see that market is not reacting as much because, RBI is on a tightening spree is now a little bit factored into the market already.
Rakesh, let me read a portion of a strategy report which hit our mailbox yesterday. And your strategy report is making a case that markets have seen a strong rotation back into consumer staples, IT and defensive names, which may not continue, and that was more like a knee-jerk reaction. So you're making a case that it is time to revisit financials.
Well, see, we are not saying that you go and buy public sector banks, but, probably private sector banks have been also hurt in this, whole downsizing. You have got good banks like ICICI, yes, which people can still look at. So I think, saying that the whole financial space is looking bad is not really correct. So we would be buyers into this dip for the private sector banks like ICICI, yes, and Axis.
The logic behind buying Axis Bank or for that matter Yes Bank or ICICI Bank, because ultimately they are also wholesale funded and the cost of wholesale borrowing will move up, which in the short term could have an impact on their margins.
Yes Bank is wholesale funded, that's the notion, but their CASA is steadily improving. It's already at 19%. So I think, while perception is that these are wholesale funded, but I think their dependence on wholesale funding is reducing quite a bit. And they are not really going to be impacted as much as the PSU banks. And probably, this is the time to really buy these high quality names at cheaper valuation. So if somebody has slightly longer term view, meaning these measures will last probably until August, September at the worst case. And we are expecting that rural demand will pick up given that monsoons are decent. Government spending is going to pick up in the second half. So I don't think there's any case to really panic too much. And I would probably be, buyers of these good quality private sector banks.
Rakesh, what about IT? Do you think all the positives, the likes of a US recovery, the currency benefits are all in the price? Is it time now to take some profits off the table? Or do you think there is still enough headroom in names like an INFI, TCS, or for that matter, a Tech Mahindra as well?
See, clearly valuations are not, cheap anymore. But I think the stocks can continue to hold on till the time there's worry on rupee front. So I would not really recommend people to, book profit as yet. But, new buying can be, refrained from. So we have a kind of a market neutral position on IT at the moment. Just to, tell you that valuations are high, but not yet ready to get out of it.
Do you think valuations are high for a stock like Infosys also? It's trading at what, 14-15 times based on FI15 estimates, 16-17 times based on FI14 estimates?
See, Infosys is not as expensive as peers like TCS, etc. But remember that you are all building in, a rupee-dollar exchange rate of 60. Which, as per the RBI's own calculation, is in an undervalued zone. So we're not really expecting rupee to remain at 60 for too long. So part of the earnings that are coming are, because of this, which are not going to stick around. So that's not a structural growth in earnings that you're seeing. And it attracts a lower multiple. So that is one. Number two is that INFI is yet to prove, meaning they have had one good quarter. But they need to prove it for another 2-3 quarters to, get that premium valuation, which, say, TCS is commanding. So I would say that, INFI looks cheaper, but it's not as cheap as what it looks optically because of the rupee thing.
Rakesh, would that be the same rationale behind the FMCG pack as well? And what is it that you would recommend there?
Difficult to make a case to buy these names at 35-40 Ps. So we have a, underweight position on consumer staples. So, this market is getting pretty difficult. People want to buy stuff which is getting very expensive. And so our advice to investors is that they should look at two trends. One is clearly the private banks that we discussed, which are looking now attractive at these valuations and probably have a better outlook. The second is that, come September, October, and a lot of government companies will be pushed to pay more dividend. Some have already announced it. So probably that is the second theme investors can look at. Companies like NMDC, Coal India, ONGC are all looking very attractive at low valuations and have significantly high dividend yields of 5 to 8%. So that is the second pack where, investors can get in. Number three is that, the other plays where you can play rupee weakness, say for example industrials, they can look at something like Cummins, which is trading at 15-16 P as compared to 30-40 Ps that you see for the other defensives. So people will have to go stock by stock into other sectors where there is companies who benefit from rupee depreciation and take a position there.
But Rakesh, your call on HUL has worked like a charm. HUL was at 400 when your analyst came out with a report on HUL. Price target I think was 630, 640. So are you surprised and also happy with how HUL has moved?
See, we are not really surprised. Basically 600 was a kind of a fair target, and what the Unilever did was they took the advantage of a downturn in the stock back to 430 to announce offer at 600. So now what we are seeing is more like a technical rally, and most of the selling is done. So at 700 odd, I think valuations got stretched too much. Probably will see very low returns in the next 12 to 18 months. So probably people can book some profits here and re-enter probably 12 months later down the line.
As a house, you have a coverage on Wockhardt. It was a buy some months ago, then the FDA problems came in, now you got to sell there. What is the way forward for Wockhardt now? Do you think it's a good time to accumulate Wockhardt, or the story is over for the foreseeable future?
The warning letter has been out now, and Wockhardt has two important facilities which go in for inspection in August. So it is yet to be seen whether the problem seen in the first facility, whether it continues into the other two facilities, and that could have a much more meaningful impact. Meaning the facility which has seen a warning letter is like 10% of their profits, but the other two are more significant and could be 40% of their profit. So we are not yet a sell on the stock. We are more of a neutral at this time. And so what we are saying is wait and watch, meaning we need clarity on the inspection which is due in August. And probably, we'll have some clarity emerge by September. So till that time, I would advise that investors should remain on the sidelines on this counter.
What about the rest of the pharma names then, Rakesh? I mean, while you do have companies grappling with their internal and external problems like a Wockhardt or a Ranbaxy, you also have a Dr. Reddy, Sun Pharma, Lupin on the other hand, which have been making fresh highs.
Yeah, so meaning while there have been problems for some companies, but generally I think the pharma companies have done extremely well, and we continue to push Glenmark, Sun Pharma, and now we've recently added Ranbaxy as our top 3 ideas in this space. So I think there's no reason for investors to really book profits here. Meaning compared to FMCG, these look cheap at 20p.
But you've got a very contrarian strategy. Buy into banks, avoid IT, buy Ranbaxy. These are very contra strategies.
Yeah, see, Nikunj, the problem is that the obvious ideas are very expensive. So we are looking for ideas which can give us the same kind of, comfort from rupee depreciation, etc., and are not that expensive. So you can say it's a little bit contra, but we think that there's a logic behind it. And secondly, we're also trying to position ourselves for increased rural spends and, government-led pre-election spending in the second half. So while things look pretty bleak at the moment, but see, monsoon is shaping up pretty well. So there's some signs for optimism also.
One of your core areas of expertise in the past has been cement, and when I interacted with you, you told me that how well you track cement stocks. What do you make of the recent, sell-off in cement? Do you think at the current juncture, large-cap cement companies are priced to perfection, especially Ambuja and ACC?
Yeah, see, we always, for the last 2 years, we've been holding our view that these companies are extremely expensive. And last 6-8 months, we are seeing only earnings downgrades come through, whereas stocks have not really reacted much. But I think, these stocks are primed for correction now. We have Ambuja Cement reporting today, and probably it will be at the lower end of the guidance or the estimates that the street has. So I would suggest that, it is a good time to really book profits here. Demand remains extremely low, and that is limiting the pricing power. And we are seeing new capacities still coming in. So there's no structural bull run which is going to happen for another 1 or 2 years. So paying 18-19 PE for these stocks looks unreasonable to me. And clearly, case to get out.
Rakesh, good chatting with you. Really good having you on the show as always. Thanks.
Thank you.